Ladies and gentlemen, boys and girls, children 18 plus, you are tuned in to the Loan Officer Podcast with me, Dustin Owen, and my main man,
JC.
John Coleman.
Dio, what's popping?
What's poppin', JC?
Oh, I got some fresh gear on today.
Dude, I'm digging the swag.
I know.
I wish there was a website where I could go online and either purchase swag.
What?
Or I wish there was a way that I could hit you up and say, hey, my man, just John, can I get some T-Lop swag?
Yeah, just hit us up. Send us an email at theloanofficerpodcast@gmail.com. And we'll see what we can do. There's no guarantees.
Hey, here are some other places that people can find us.
Okay.
They can find us on TikTok, Instagram, Facebook, and LinkedIn at the Loan Officer Podcast. Yes, I am Dustin Owen on LinkedIn. If you want to connect and we're not already connected, let's connect on LinkedIn. Mm-hmm. If you want to message me, it's a great way to get a hold of me. Mm-hmm. Message me on LinkedIn. Yep. If you want to get a hold of John, besides the Gmail account he just threw out, you can also Google him, just John Coleman. He is all over the interweb and you can find him. If you are tuned in via audio and audio only and you want to see some of the T-Lop swag that John Coleman is wearing, you can do so by checking out our YouTube channel, The Loan Officer Podcast. If you haven't done so already, please subscribe. Yep. On YouTube is a great place for you to leave comments, to give a thumbs up because you like what we're doing,
yes, sir.
And it can turn into a bit of a forum.
Yep.
If you're not into watching us and you could care less about the swag that JC is rocking, and you only want to listen to us because maybe you're in the car, you're on your way to the gym, or you're sitting at the beach, Spotify, Apple Podcasts, Google Play, or anywhere that you can find podcasts, we can be found. The Loan Officer Podcast with Dustin Owen is the formal name of the show. Please subscribe, give us a 5-star review, and share with your friends.
Thank you.
Whew.
Well, that's all the time we have for today's episode. We are so glad you guys tuned in.
Yeah, the video camera's going to cut out in 3, 2, 1. There it goes.
What if we did? That would be funny.
What if the video camera?
No,
that guy who's always bashing us on YouTube.
No, I'm not.
Would come out from underneath the bridge and be like, your video cuts out. I wish you weren't so cheap. I'm like, bro, this is a passion project. Right. This is a hobby.
Right.
Yes. Right now. For now. Right now, if I went or JC went and dropped $2,000 on a camcorder.
That would be
we have significant others who may have an opinion on where our money is spent.
Right?
Yes.
Like your wife?
Your wife's going to be like, John, how come you didn't take me to that really cool Indian restaurant that I love to go to?
Shout out Tamarind down the street. It's really good. No, we have separate bank accounts, Dustin. We talked about that. It avoids many headaches.
Good for you.
Smart man.
See, I moved in with my girlfriend at 22. We were married at 24.
And you haven't looked back since. And it's been a wonderful ride thus far.
It's been an amazing 19 years going on 20. We're thinking about spending our 20-year anniversary. Originally, it was going to be Italy.
Okay.
We're going to Italy. Here's what you realize. When you have 2 teenagers at home and a couple businesses that you help run, and my wife does a ton of volunteering.
Can't really go out of the country.
And we have other family obligations. Leaving the country for 10 days doesn't really work. So we're not even going to go. We're going to look at Maine.
Okay, Maine's really nice.
Yeah, Vermont, New Hampshire. We've never been up to that part of the country.
There's no need to.
We're trying to hit all 50 states by the time we're 50.
There you go.
So I think that's what we're going to do.
Nice.
Yeah, and if I could somehow fill it by way of Philadelphia, because I have to go to a Phillies game to get that stadium knocked off.
There you go.
Or I also need to get to Cleveland to get that stadium knocked off. I know they're not really in the area.
There's really no need to go to Cleveland.
You know what I do? I need to go do a branch visit. My boy Jesse DiGiacomo.
Shout out Jesse DiGiacomo.
Shout out to Jesse. Jesse, no lie, I think last year closed 500 units, 600 units.
No, he didn't.
It was ridiculous. It was the most units in the company ever. Like no one's ever done this many units.
Damn.
Yeah.
Okay.
And he's right outside of Cleveland.
Okay.
In Warren, Ohio.
Sounds out there.
Yeah, but I think Jesse needs to invite you and I
up
to Warren, Ohio. Shout out to Jesse if you're listening.
Shout out Jesse.
So that we can bring our talents. You know, LeBron brought his talents down here.
To South Beach. We'll go back up.
We're going to bring our talents back up to Ohio.
Nice.
Which it's debatable whether or not Ohio is even a state. I'm learning. I've been on the interweb a little bit. They're talking about, is Ohio really a state or is it not a state? Really? I'm leaning towards it's not a state, but maybe we have to go up there to check it out. And while we're there,
we should drop some episodes.
Maybe we can get Jesse to do an interview with us. He'd be an amazing interview. And wouldn't our T-Lop listeners love to hear from someone who closed 500 units last year?
They might be so intrigued to hear how he did it.
Yes, and he's a good dude. and we can go to an Indians game.
It literally sounds like they changed their name. They're not Indians anymore. Remember, it's
Native
the
Americans?
Guardians.
The Cleveland Guardians. Okay. All right, I can buy into that.
Yeah.
Yeah. Does Albert Bell still play for them?
No, it's Kenny Justice. David Justice?
David Justice. Damn. I don't know if David Justice ever played for the
Albert Bell. No, it was the Braves.
It was Joey. Don't call me Albert Bell.
Who's the other one that I like? Albert Bell, David Justice.
Dave Justice went from the Braves to the Yankees to the Athletics. Justice was a part of the Athletics team that broke the record for most consecutive wins. And then they made a book and then a movie called Moneyball. Oh. Moneyball stars your man Brad Pitt.
That's your boy.
Yeah, Brad Pitt's the man.
Yeah, all right.
Brad Pitt in Fight Club was probably my favorite Brad Pitt.
Yeah,
you probably like Brad Pitt in
nope, the alien one where he's flown in space by himself.
I didn't know it was Brad Pitt. That's Matt Damon.
That was the Martian. No, that was the Martian. There was another. No, that was George Clooney. They all look the same and act the same.
Oh my goodness, that's semi-racist, John. I'm not even going to go there with
good-looking Hollywood actors. That's what I meant. That's where your mind went, Dustin. They all look the same. Good-looking Hollywood actors. That's where your mind is, in the gutter.
All right, what are we going to talk about today, John?
Nice,
John.
I know, nice pivot point because this feeds right into it. Non-occupying co-borrowers.
Non-occupying co-borrowers. Perfect. This
Perfect
is
segue.
literally, okay, this is for parents who have adult children who you want to get out of the flipping house, out of the basement, out of your Florida room, and you want them to buy a home. Parents who maybe have college-age children. Maybe they're like my kid. He wants to go to UC Irvine. Maybe I don't want to pay for a dorm. Maybe I want to try to buy a house. Maybe he wants to buy a house when he gets out there. But his W-2 from Chick-fil-A isn't going to be enough for him to qualify for a home in Manhattan Beach, California.
Probably not.
So maybe he's going to need somebody to, the term that many people in the credit card and auto industry use is co-sign.
Co-sign.
We don't really have co-signers in the mortgage business. We have non-occupying co-borrowers.
Okay.
So that's what we're going to talk about. Realtors. This applies to you. You sell real estate for a living. You should know the power of a non-occupying co-borrower and why you would introduce them to the transaction. And then obviously for our mortgage professionals, it's going to speak to you because as you originate loans, you have to understand when, how, why you would ever use a non-occupying co-borrower. And then word to the wise, when you're speaking to the consumer, right, to that home buyer, use terminology that they understand. Say a pet peeve of mine, right? Like we have mortgage processors who like to like copy and paste the conditions from the underwriter and email them to the consumer. And it says things like, you know, need LOX regarding BK.
Whoa. She need some cheese from Burger King?
Correct. Yeah. Letter of explanation regarding the bankruptcy. Like, come on, guys and girls. Let's speak the language of the people that we serve.
Right.
Let's not speak our jargon.
Right.
Same thing goes for my doctor friends, for my law enforcement friends. Like, please, I did listen to enough 80s and 90s rap. I do know what a 187 is, but I don't know all the other codes.
344. I don't know what that is either. I just thought you'd.
143, if you're on a pager, it means you love me.
There you go.
Remember that back in your beeper
Pagers.
days?
Shout out pagers.
Yes. But so I interchangeably will use the term co-signer with non-occupying co-borrower, but technically they're two separate things.
Okay.
Technically, if you're talking industry and you're geeking out with another mortgage professional, say non-occ, non-occupying co-borrower.
Gotcha.
Hey, do you have a non-occ on here? If you're talking to the consumer, call it a cosigner. That's what they know.
That's what they know.
They don't know non-occ.
Right.
They don't know non-occupying co-borrower. If they're really smart, they can use context clues. What does that mean? Non-occupying co-borrower. Okay, someone who's going to help me qualify, but they're not going to occupy the property.
Okay.
All right? So we're going to rock and roll on this subject matter.
Let's go.
The biggest misconception when it comes to non-occupying co-borrowers is that you introduce them for credit score. Hey, man, I got a great job. I got money in the bank, but my credit sucks. But don't worry, my dad will co-sign for me. Hey, man, that's not going to work.
Oh, okay.
Hey, man, that's not going to work.
It doesn't work like that.
It doesn't work like that. It may work like that if you're trying to get a credit card or a car loan.
Not a home loan.
It does not work that way in a home loan because when you're getting a home loan, we're going to go off of the lower of the two credit scores. So if your credit score, you have one, is a 580.
Oh, you're still going to get, you're still a 580.
You're still a 580.
What?
You're still a 580. The only time, and I'm just hitting this like right out of the park.
Right.
Let's get this knocked out. Let's get this out of the way. The only time you're ever going to introduce a cosigner, also known as a non-occupying co-borrower, when credit is a determining factor, is let's say you have no credit score.
0.
Like literally, John, I tried to pull your credit and it's a ghost.
Nothing's
And a lot of times that happens because maybe you're an immigrant to the country, you legally immigrated, and you have your Social Security, and you have your visa, you have your green card, but you just haven't had an opportunity to establish credit.
Mm-hmm.
You know, you maybe have been renting for the past 2 years, and you can verify that you've been renting, you've been paying your rent on time, you have utilities in your name, cell phone in your name, cable bill, et cetera, et cetera, et cetera. But you still don't have a credit score, but you have a family member who maybe they've been in the country a little bit longer than you, and they have an established credit score. It is very possible for a mortgage lender to be able to take a no credit score with a credit score, run that file through automated underwriting, and obtain an approval. Okay, but that's someone who has no credit. I'm talking about if you have bad credit,
no go.
No, it's a no-go. We're going to qualify off the lower of the two, and if the lowest is yours, although you have a great job and you have money in the bank, if you have a bad credit score and it doesn't meet the threshold, let's say it's, again, you're a 580 and 620 is the minimum that's needed, then it doesn't matter who cosigns for you, right? That's not going to matter. Where a non-occupying co-borrower benefits, and this is like 90% of the time, is when we have someone who's trying to buy a house, utilize financing in order to qualify, and their debt-to-income ratio is too high for whatever reason, right? Maybe your debt-to-income ratio is too high because after you file your tax returns and you and your accountant go through your preferred accounting methods and you write off certain expenses, it has lowered your taxable income, which then lowers your qualifying income. Maybe you have a side job that for whatever reason, we can't use that income. Usually that for whatever reason is you haven't been doing that side job enough or long enough. But you're like, man, I've been doing this side gig for the past 9 months, and every single month I'm making $3,000. That's how I was able to save $25,000 so quickly for this home purchase, is because of this side hustle. It's amazing, and it's only going to get better. Well, unfortunately, if I don't have 2 years history of you working your full-time gig and the side hustle, I can't use that money. So, okay, you have good credit. You have normal debts, but you needed that $3,000 side hustle money to qualify, but you now don't qualify. Let's talk about introducing a non-occupying co-borrower. Now, certain loan programs are going to require that person's a family member. Certain loan programs, it's not going to matter that they're a family member, right? Like that's check with your loan officer. Make sure your loan officer does he or she's due diligence. There's certain loan programs where they're not going to allow for a non-occupying co-borrower. My veterans out there, my active duty military folk.
You can't do a call.
No. Well, okay, someone's going to tell me technically you can.
Right.
Okay, technically you probably can, but then it's going to require a much larger down payment than you were ever thinking planning to have, at which point it's going to blow up your transaction.
Gotcha.
So technically a VA loan is for veteran or veteran and spouse, period, end of story.
Gotcha.
And I don't even know off the top of my head, I should know this. I should probably have a VA home loan expert on this show, like a Dawn Hoffman, who's a top producer. I've known Dawn for almost 10 years now. And maybe I can get Dawn to do a show with us where we just talk about the ins and outs of VA.
That'd be dope.
But just know that not all loan programs would allow for a non-occupying co-borrower, just FYI. But why you would introduce a non-occupying co-borrower is going to be because of income reasons or debt to income ratio restrictions. They kind of go hand in hand. You've heard many times on the show, John, I'll talk about like the number one factor to me on whether or not you qualify is your debt to income ratio. Right. Like it doesn't matter if you make $1 million a year. It doesn't matter if you have $1 million in the bank. If your DTI is out of line, your DTI is out of line, right? You can make $1 million a year, which is like $83,333 a month. But if you already have $50,000 a month in expenses, right? Like maybe you have some like Kelly Clarkson style alimony and child support.
Yeah.
Did you see what her ex-husband's getting?
Racks.
Yes. Homeboy's getting paid.
Damn, I messed up.
Yes. I'd be her ex-husband for like a third of that money. Yeah, and I'd be a better dad to the kids.
Damn it.
Yeah, missed out on that boat.
There you go.
I still love you, Michelle.
Right.
Totally off on a tangent there.
That's fine.
But if you have a high DTI, then you're going to want to introduce someone.
Right.
So then we start asking ourselves, well, what type of person
Right.
do we want to introduce? So if we're introducing them because you as the buyer or your client as the buyer has not enough provable income or they have too high of a debt to income ratio, then obviously I'm looking for someone who has provable income.
Right.
Like that's it. Provable income and low debts. Because when you're a non-occupying co-borrower, John, you have a housing payment.
Well, I do?
Yeah. And you may be like, oh no, do I have my home paid off?
No, my home is paid off.
Okay. Do you not have real estate taxes?
Oh, snap.
Do you not have homeowners association dues?
Yeah.
Do you not have homeowners insurance on your property?
Oh, yeah. I forgot about those things.
Okay. Well, then there's an expense. Now, it's not a $2,000 a month expense, but if your taxes are $3,000 a year and your insurance is $1,800 a year, there's $400.
Yeah.
If you pay $100 a month in HOA dues, there's $600, right? So like you very quickly have some kind of a housing payment. So let's say if you're not John Jr., but you're John Sr., and you have your house paid off and you have, money in the bank, but your only income is your Social Security at $900 a month,
You're not going to qualify.
you're not going to bring any value as a non-occupying co-borrower.
Hmm.
Right? You're like, it's cool that you have money in the bank, and it's cool that you have this 800 credit score, and it's cool that you own your house free and clear.
But you don't make
But if
enough.
your only income is Social Security and it's $900 a month, and just your taxes, your insurance, and your HOA dues are $500,
Yeah, that leaves
your
you.
DTI by itself is already over
Yeah.
50%. So I'm looking for, or the consumer is looking for, a non-occupying co-borrower that has equal to better credit than the borrower or the buyer. They have low debt and high provable income.
Are there any risks to the co-borrower signing?
Yes.
What can happen? What can go
If
wrong?
you buy a house and I'm your non-occupying co-borrower and you don't miss a payment, that wrecks my credit. I now have a delinquent payment on my credit report.
What?
Yes, I'm vouching for you.
Damn.
Yeah. If you don't make the payments, right, then I've acknowledged that mortgage, and now they're going to foreclose on your property.
It's gonna ding me.
Yes, I'm going to have foreclosure in my name, and I'm not an attorney, so you would want to reach out to an attorney. If you need a good attorney, I know a few here in Central Florida. I don't know any outside of Central Florida. Thank goodness for me. But if you co-sign for someone who went into foreclosure, there's a chance you could have a deficiency judgment against you.
Damn.
Yeah, so there's definitely some risk that goes along with it. So if someone's going to ask you to be your non-occupying co-borrower, you better know them. You better trust them, right? They better have a good reason to go to you.
Are there any benefits if you were doing a co-borrower other than watching a loved one get into a home or et cetera? Like, do you get any?
No,
Nothing, right?
No. Now, some people might be like, oh my God, I don't know if I want to be a non-occupying co-borrower, because if I want to buy a house on my own, is this going to jeopardize me being able to qualify? Maybe, maybe not though. Because if the person that you co-signed for a lack of a better word, if they made 12 on-time payments and they always made the payments out of their checking account that was just in their name and you weren't attached to it, there's a really good chance that when you go to apply for your own financing, as long as you can prove to your lender that, yes, I know that mortgage shows up in my name, but I don't make the payments. In fact, I have proof that the past 12 months have been paid by my sister, then very well, most loan programs and most loan products are going to allow you to omit that debt from you who's trying to buy and finance a new home.
Gotcha.
Or hopefully you may just qualify. You may just qualify carrying your sister's mortgage plus your own mortgage.
Okay.
Especially if you're high income, low debt. Like an example I always use is I helped family members back in the day, right? So we had this one person, and we'll call her Ann.
Okay.
And Ann had just left her job that paid her $100,000 a year, and she started her own company.
Okay.
Everyone was super proud of Ann. Like, high five, you go, girl. Like,
Right.
you're going to do this. Unfortunately, Ann didn't realize that when she left her job that was salaried in W-2 to $100,000 a year to start her own business, that any mortgage underwriter is going to require 2 years of business and personal tax returns in order to qualify for a mortgage. So now her income is zero. It didn't matter that she made $100,000 last year and the year before and the year before and the year before. She quit that job. That guaranteed income is now zero. And all Ann has is this great idea, this great following and these contacts that she hopes she's going to build into a corporation that will pay her $100,000 times 3.
Mm-hmm.
But we're not going to do a loan for her until she proves that she's actually done it.
Damn.
Crap. And Ann's pretty normal. You know, she has her good credit score, 680, 720, somewhere in that ballpark range. And she has a couple $100 a month in student loans and a couple $100 a month in credit cards and a car payment at $400 a month. But her income is 0. Now, Ann's dad, he's nearing retirement. So someone nearing retirement, they're late 50s, early 60s, maybe late 60s in today's day and age. People are living longer, healthier lives. And he has his house paid off. But, you know, like John Sr., he still has $500 a month in taxes, insurance, and HOA dues. But this dude, I mean, he makes $120,000 a year. So he makes $10,000 a month. His debts are literally $600.
Damn.
No car payment, no credit cards, no alimony, no child support, and has an 800 credit score. So his credit score is better than or equal to Ann's, which it was better than. His income, very provable, been on the same job for 30 years. He's a union guy.
There you go.
Makes $120,000 a year. I know that because I have pay stubs, W-2s, and tax returns that prove it. His income his debt is next to nothing. So when you're having a non-occupying co-borrower, here's what we're going to do. We're going to treat Ann and her dad the same way we would Ann and her spouse.
Oh, okay.
Okay. What's Ann's income? 0. What's dad's income? 10. Okay, 0 plus 10 is $10,000. So the income is $10,000. What's Ann's debt? $1,200 a month. What's dad's debt?
$600.
Yeah, and it's not even really debt, but it's his housing expense. So we take Ann at $1,400, dad at $600. Like how I changed the numbers on here. Now it's $2,000. Okay, my income equals 10. My debts equal 2. Well, I know that I can probably get Ann qualified for a debt-to-income ratio of 45%. So 45% of 10,000. John, do you know that number, or should I answer it for you?
Half is 50, so I'm gonna go like.
What's 45% of 100?
45.
4,500. Yep, you got this.
I'm a math major.
You high five to you. So this, by the way, this is how a mortgage professional does their job. This is a pre-qualification, not a pre-approval, right? Because in order to pre-approve someone, I actually have to have tangible documents and review them. But if I'm on a phone and I'm having this conversation with Ann and her dad, I'm like, okay, look. So I have Ann's income of 0, and here's why it's 0. And, you know, Ann's usually a bit upset because she's like, no, my business is going to kill it. And I know it is. But right now we don't have proof to prove that it's going to kill it. So we have to use what the bad guy, right? The rules and regulations let me use. 0. But dad makes $10,000 a month. That's, you know, 0 plus 10 is 10. 45% of 10 is 4,500. Your debts plus dad's debts equal 2,000. So when I subtract $2,000 from 4,500, it leaves me with you're there, 2,500.
2,500.
Yep. Hey, Ann, I have good news for you. By bringing your dad in as a non-occupying co-borrower, you now qualify for a maximum payment of 2,500. And Ann's like, well, first, that's way too much.
Yeah, I didn't.
I'm only looking to go up to like $1,800, $1,900 max. All right, perfect. Hey, Ann, good news, bad news. Bad news is because you recently quit your job, you will not qualify on your own. Good news is if dad's really cool with it, if dad comes in as a non-occupying co-borrower, you're going to qualify for more home than you want to afford.
Word.
Yeah, and that's where we see a non-occupying co-borrower really work. Now let's look at it as a 20-year-old going off to college. First year was in the dorm. Second year was in the sorority house. Third year?
Mom, I think it's time I move off campus.
Yeah. Okay. Well, hopefully mom and dad were fiscally responsible and they taught daughter maybe at age 18, they made her an authorized user on their card. They helped daughter go get a couple starter credit cards, maybe even got a car loan and put her name on it. So she has a credit score. Okay. But her only income is like, you know, a little bit of money she gets by tutoring kids at the local, you know, tutoring place at $11 an hour. And she's only doing that 15 hours a week. But maybe she could qualify for a 3% down loan, buying a home as her primary residence so she can live in this home for the next 2 years while she finishes out her college experience. Ooh, well, maybe she buys the house. She's the borrower. Mom and dad come in as a non-occupying co-borrower. That's very doable. Now, there are other loan products that would allow the mom and dad just to buy the home altogether. Right now, but they would maybe require mom and dad to put 10% down to buy it as a second home or 20% down to buy the home as an investment property. Where maybe if, you know, their daughter has a usable credit score, then daughter can buy the home as long as she's a legal adult, have mom and dad as the non-occupying co-borrower.
What happens if someone uses a non-occupying co-borrower and the co-borrower actually lives there? Is that a thing, or is that just called marriage? You know what I'm saying? Like, is there like a loophole somewhere?
No, if that's the case, you'd just be a joint application.
Okay.
Yeah. Now it's just a co-borrower.
Now, okay.
Yeah, borrower and co-borrower.
Okay.
Yeah.
What's the difference between borrower, co-borrower, and non-occupying co-borrower then?
Well, a co-borrower means you're gonna live there.
Okay, that's what.
Non-occupying is just that. Hey, I'm not gonna occupy this home.
Gotcha.
Yeah, like Ann's dad was not going to be ever living in that home.
Right.
So he could not be on a co-borrower. Right. And that would be fraudulent, by the way.
Right.
Right. And there's definitely some loan products that do not allow for a non-occupying co-borrower. Like just like certain loan products, you can't do gift funds.
Right.
Like I can't buy an investment property and get a gift from my parents for the down payment. It's not allowed.
Gotcha.
If I'm buying an investment property, that loan's going to be in my name. I have to prove that those are my assets.
Gotcha.
Yep. So there's definitely some rules and regulations. And that's why I'm always like, look, you got to make sure you're working with a local, professional, experienced loan originator, preferably one that has local processing and underwriting, and they have a direct line to maybe a scenario desk, so that when these quirks come up, they can get them answered correctly. And you as a consumer, if you're a consumer listening, you as a consumer can get the right answer quickly, right? Versus the wrong answer late in the process. Right. That's how we end up with loan denials.
When do people usually bring in a co-borrower? Is there something like in the beginning, or like after you guys run the numbers and like, hey, you might need to bring some?
Yeah, that's a great question. Always look to apply by yourself, right? Like whether it's you and spouse or you and significant other, or hell, it could be just you and your college best friend.
Right.
Like what if me and my college best friend, who also was my high school best friend and my middle school best friend, what if he and I at 23 wanted to buy a house together? We could. There's nothing that prevents us from doing it. Same thing, as long as he has a qualifying credit score and I have a qualifying credit score, we're going to go off the lower of the two. We take his debts, we take my debts, we take his income and my income, add it all together. He and I could buy a house together. Like that's very doable. We would be borrower and co-borrower. Gotcha. We would not be non-occ because we're both going to occupy the property, right? Because maybe he and I went super crazy and bought a duplex together. Maybe he lives in one half, I live in one half. Maybe we bought a duplex together. I live in one bedroom, he lives in the other bedroom, and we rent out the other half. Right? Like there's, all sorts of things you can do. You don't have to necessarily buy a house with your spouse or your significant other. But you normally would start by applying however you're going to apply. And then when you realize, oh crap, I'm not going to qualify. You're normally not going to qualify because you don't show enough income, or the income you show isn't sufficient due to your debts. That's a debt income ratio issue. So you want to add in a non-occupying co-borrower, aka a co-signer, but the person you want to bring in needs to have equal to better credit than you. They could potentially have worse credit. Like theoretically, if I had a 780 and my non-occupying co-borrower had a 680, they're still going to benefit me. Just know that 680 credit score is going to drag down the interest rate that I would have qualified on my own, but I wasn't qualifying on my own, so it doesn't really matter. Right. But I'm going to bring them in when someone tells me, hey, DO, good news, bad news. By the way, as an originator, I love good news, bad news. Hey, John, good news, bad news. Good news is that you qualify for a mortgage. Bad news is it's nowhere close to what you were looking for. When you and I first talked, you were trying to buy a $300,000 house. You wanted to put your 3% down. Based on where I'm estimating payments to be, your maximum payment that you qualify for based on your debt income ratio is about $1,200 a month. And in order for you to buy a home and have your payment at $1,200 a month, you're either going to need to put about $150,000 down on that $300,000 home, or you need to look for a $150,000 house. And you're like, well, I'm doing neither of those. Usually it's not a fun phone call to have. People get very frustrated. They want to kill the messenger. I'm like, look, don't kill the messenger. That's why I remind them, I'm a 100% commission salesperson. I only get paid when you close a loan. I only get a raise when you tell your friends, family, coworkers, and neighbors how great of a job I did for you. So I really want to do a great job for you so I can A, get paid, and B, so you can refer me to other people. But right now, as your advisor, as a consultant, as an expert, this is what I'm letting you know. But here's a thought. I don't know if you have this. And by the way, this is exactly how I say this. I don't know if you have this because not everyone has this luxury in life. You may and you may not, but I'm going to throw it out there. If you have someone who is willing to co-sign for you, we could look at adding their income to your income, their debts to your debts. And as long as their credit is in line, we could then look at qualifying as long as they're fine being a non-occupying co-borrower.
Oh, okay.
What you would also call a co-signer.
Right.
And then a very typical question that we get on this topic is, well, then how do they get off the loan? Well, John, it is very possible once your situation has improved, maybe you've paid down some of those debts, maybe you've gotten a raise at work, maybe that side hustle money that we couldn't use, we now can use. Once your situation improves, we can look at doing a refinance where we qualify the new loan just in your name and we refinance them off of the loan. Just keep in mind, right now, interest rates are at an all-time low. Right. So there's a good chance in 2 years or 3 years or however many months it's going to take for you to better your situation, there's a good chance rates may tick up, but that may be a small price for you to pay in order to get your non-occ off. Because, look, once they sign, they are going to be obligated to make sure payments are made and made on time on this particular loan.
Say I'm a dad or a grandfather and I have like 10 kids. Is there a limit to how many, like, can I be like a non-occupying co-borrower, like 50 homes if I so qualify? Not 50, but like 7. Let's say 5 homes.
Yeah, but you just have to keep in mind that every time you do that,
it's going to put a dent in your...
No, you're thinking a dent in your credit score. I'm less worried about that. I'm thinking when you go to be a non-occupant co-borrower, for me, you now have my mortgage on your credit. When you do it for my sister, you have her mortgage on your credit. When you do it for my brother, you have on your credit. Now have. So then you and your loan officer are going to have to work through John Sr., daddy to 7.
Right.
Can you prove that you no longer, like, you don't make the payments on my mortgage because maybe you did this for me 3 years ago and I have the past 12 months a canceled check showing that I make the payment? And then is your lender going to be able to omit that debt from you? Then can you do the same with my sister, the same with my brother? Theoretically, it could be done, because theoretically, if you could prove that you're not the one making the payments, that debt is not being added. Or maybe you're John Coleman of John Coleman Chevrolet and you have 3 car dealerships and you make $900,000 a year. So at $900,000 a year, that's $75,000 a month gross, at which point you can carry all those mortgage payments. Right? If each of your kids had a $2,000 a month mortgage payment, it's only $14,000. Right? 45% of $75,000 is way greater than $14,000.
Okay.
Yeah. So yes, it is possible.
Okay.
Yep.
I was curious.
How does that do? Like, how does that sit? If you're a listener tuned in right now, whether again you're someone who's younger in life looking to purchase your first home, but you're afraid you won't qualify on your own, this episode's for you. If you are a parent with adult children, you want to get those little bastards out of your house. Are you willing to put your money where your mouth is? Right? If you're a realtor who sells real estate for a living, if you're a mortgage professional, I hope that this brought value to your day, that this was worth the 30 plus minutes that you just spent listening to me and John talk. Yeah. If you like what we're doing, do us a favor. Hit us up on Instagram, Facebook. Check us out on TikTok. Follow us on LinkedIn. We are at the Loan Officer Podcast. Subscribe to our YouTube channel. Use that forum as a way to comment. Let us know what you like. Let us know what you don't like. Let us know what you want more of. Once you do that, hop over to Spotify, Apple Podcast, Google Play, and anywhere else where you catch podcasts. Make sure you're liking what we do, you're giving us 5-star reviews, and you're sharing it. If there's something you want to hear more of, or you need clarification, LinkedIn is a phenomenal way to get a hold of me. I am Dustin Owen on LinkedIn. But for today, this is all the time we have for today's episode. We'll catch you on the next episode. He's John Coleman. I'm Dustin Owen. We're out. Peace.